Everyone, how are you? Cameras on, please. Looks like we're good on YouTube. Okay. If you're watching on YouTube, let me know that you're there, so I know that it's you're seeing it. Let me know in the chat so you can participate as well, and I can answer your questions. All right, and let's see who's here. We got Yurka, we have Elena, Vanessa, Ingrid to the side. We have Stephanie M, Brian, Francielli, Robin, Yvette, Yami. He's here. All right. We got David in the car. David, you're learning from everybody else. Come on, get out of the car. Shame, shame. Gonna talk to your wife about that. I see Fabiola. I see Bianca. Alondra, Muslima. Where's your camera? All right. Got Stephanie, the other Stephanie. So Princess right there. We got the Jeffrey, Chris, Miguel. All right, cool. All right, Jacqueline Johnson, you're also there. You're on YouTube. Great. Anybody else is watching on YouTube, let me know so I can address your questions. Okay. All right, guys. So is there any question you guys want to... I know we had a 2-day real estate finance chapters. We broke it down into 4 parts. That's pretty much what we did the day before and the one before that. So do you have any questions regarding financing before we move forward? Because we're going to get into investments next. So before I proceed, I want to make sure we're clear on any issues that might have come up while we were going over those chapters. So let me know. Drop it in the chat right now if you have. Okay. All right, I don't see any questions coming through. And I already know how it is. In about 2 minutes into the actual class, somebody's going to ask a question. Let's see. Guys, make sure you're on the cameras. Make sure you're paying attention. All right, cool. Since there's no messages coming through, we're going to move forward into real estate investments. Now, real estate investments is really not, this chapter at least, is really not what you guys are expecting. You're probably thinking, oh, we're going to talk about how to invest in real estate and what the options are. Well, we've been doing that. I've been throwing you hints here and there, but this is not the course to teach all the different aspects of real estate investment. But you need to understand the investment fundamentals, right, before you can help somebody invest. So another thing I can say about this is if you're not the pro at it, if you just learn the basics, should you really be talking about investments to a client? Or should you bring someone that has experience to explain to your client, hey, this is what you should be looking at, or that's what you should be looking at. And with that being said, I'm not telling you to bring the pro at investments, but somebody with a little bit more knowledge and experience in investments, as well as, very important, sorry, I'm trying to let the cops go by, as well as, very important, having a CPA and an attorney that you can trust or that your clients can trust. It's very important because as much as I can give advice myself as an investor, based on my 15, almost 16-year experience in investing, as much as I can give advice, your particular situation is different than mine, right? The same way somebody needs to get approved for a mortgage and they have a different credit score, they have different jobs, they might already have a house and not qualify for a second house depending on their stress level. When I say it's financial stress, not stressed. But the same way everybody's different for pre-approval, everybody's different for tax purposes. So a CPA is something that's very, very important when dealing with investments. If you don't know what a CPA is a certified public accountant. I'm not talking about a tax preparer, and I apologize if you are a tax preparer. I'm not trying to offend. What I'm trying to say is, when it comes to something to this level, investments, a CPA, it's like having a licensed electrician versus somebody that knows how to do some electrical work in the house. A licensed electrician puts their license on the line. A tax preparer, for instance, versus a CPA does not. A CPA does put their license on the line. So if there's any mistake, you can always go back to them and say, hey, what did you do, right? Or what didn't you do? While a tax preparer is kind of like, hey, I know how to prepare taxes. We do have a number, by the way, I'm a tax preparer as well. We do have a number, a PTN number, which is to allow you to prepare taxes. So you register with the IRS, and the IRS gives you a PTN number that allows you to prepare taxes for other people. But that doesn't necessarily mean I know everything about taxes. Like if you come to me and say, as an example, you come to me and say, hey, Bruno, can you help me do my taxes? I have my W-2s, right? The W-2 means you're an employee, and it's a very simple tax preparation. Can I do that for you? Sure, not a problem. I got my PTN number, and it allows me to do this stuff. There's other people out there that are tax preparers, but they're not registered with the IRS. So you understand what I'm trying to say? It's very, 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 very difficult when you go to this realm. It's very difficult to just rely on a tax preparer because they might not have the necessary knowledge. Okay, so always look for a CPA if you can. If you have a tax preparer, I'm not telling you to get away from it, but consult with a CPA. What's the next level for your particular situation? Very, very important, in my opinion. Very, very important. Okay. If you guys ever need attorneys, CPAs, any type of recommendations, do reach out to me and I'll be able to address that. All right, now that we got Ms. Vasquez on camera, we can now proceed to the class, with the class. All right, cool. So, real estate investments. Let's go over investment fundamentals. Investment fundamentals. You guys ready for this? Thumbs up. Great. Cool. So, investment characteristics, rewards, risks, and different types of investments. Okay. So, the idea of investment is simple. Take something of value and put it into work in some way that increases its value over time. Actually, let me do something first. Sorry. Let's go here. I always ask this question in the previous classes, so why not do it here? What does this word mean? I know we just read something, but what does this word mean? Can anybody let me know in the chat? What does this word mean? Investment. Waiting. Make money out of money. Interesting. Okay. Nice thought right there. Make money out of money. We're going to clone you. That's what we're doing. Clone the money. Financial disposal. Okay. Placing your time or money into something. ROI, return on investment. Okay. Something you put or take stock in because you see it as valuable, or make the money grow. Okay, we start with a tiny note and you make that note grow over time. Yes. Take something that have value to increase value. Okay, great. Let's stay here for a second. Oh, right here. Stop. Right here. Okay. Investments. Take something that has value to increase value. Okay? So some of you wrote money. It's not always money. Sometimes what we invest, I saw this somewhere here, right here. Sometimes what we invest is time. It's not money. Look, a lot of deals that I get into myself, we have building capital as well. Yeah, Jacqueline, it's building capital goes into it. But I have a lot of deals that what I do is I put my expertise into it, and that's how we partner up. Let's say all of you guys have some type of money. Well, I have the expertise. I have almost 16 years investing. So I would partner up with you and say, look, I don't put anything, but I'll manage the deal. As an example, that's my contribution. It's intellectual property. That's the value that I'm putting in compared to your value. So technically, I'm not putting any money. I'm putting time and effort. Does that make sense? Now, every time we invest, we expect some type of return. Isn't that correct? But do we always get a return? We are investing. Thank you, Nirka. So we are investing time into this class in hopes to add value in the future. There you go. But you invested money as well. So both investments are here, time and money. So, but the question was, do we always get a return on our investments? Money, time, whatever. Do we always get a return? Sometimes we're just wasting time. Sometimes we're just wasting money, right? So we don't always get a return. So that's why I did not take this as an answer right away. I did not take this as an answer right away because sometimes we don't get a return on investments. We get a negative return. We get no return, right? Or just a wash. So it's still valid, the ROI, because that's the intent of an investment, return on investment. That doesn't always happen. So is it possible? Is it possible that an investment could be a bad investment? Yes. So that means we don't have a guarantee at all that our investment is going to work, correct? So that means that with every single investment, there's a certain degree of risk. What is investment? A risk. Simply stating it, it's a risk because you have no guarantee of the return. It could be a high risk investment, medium risk investment, or low risk investment. Low risk means it's almost guaranteed that you'll get some type of return. Medium, you're looking like a 50-50 chance, and high risk investment is you're barely ever going to get a return out of this, right? But if you do, it's great rewards. So investing in a stock market, for instance, usually it's high risk investments, right? You might win it, you might lose it, but when you do, usually you win a lot. We have medium risk investments. Let's look at your job. The medium to low risk investments, right? It's your job, for instance. You're investing time in exchange for money. So low risk, sometimes medium, because you don't know what's about to come, especially now in the current situation. Medium risk investments as well, relationships. And the reason why I'm saying, some of you might laugh, but the reason why I'm saying relationships, it's because the relationship, any relationship, has the biggest variable ever, the biggest risk, which is us, people, right? When there's two people, there's always a greater risk. When there's 100 people, and I'm not saying for you to go out and be in an open relationship or whatever, that's not what I meant. But when there's 2 people in the investment, there's a great risk of us not understanding each other, right? When there's a bunch of people in the investment, well, we can vote, right? And then some will pull the weight of the others. That's the way it works. So we start reducing the risk. If the two of us, let's say, going to purchase a property right now, right? And one of us goes like, no, I want to sell it. I just want to make 5K. That's it. That's all I want to make, 5K. And the other one goes, no, I want to make 100K. I have to make $100,000 or I'm not doing this, right? What is the biggest variable? Is it the return on investments? Is it the investment itself or the people? You see what I'm trying to say? So people are the biggest variable in every relationship. Sorry, let's try to get Verona in here. She's just sent a message. All right. So the biggest risk, investments. Now, let me ask you something, guys. What about gambling? What about today's Cash for Life or one of those, right? What about gambling? I'm going to put $2 into a ticket that might give you millions of dollars. What is that? Low risk, medium risk, or high risk investment? What do you guys think? Low, medium, or high risk investment? What do you think? Let me know in the chat. Whoever's watching on YouTube, give me this answer as well. Gambling. Is it low, medium, or high risk? When you pay $2 to go bid on a Cash for Life, Mega Millions, Powerball, like the lottery, whatever it is. Yvette, that's a good one. All right, so we have majority of people here are saying low risk. Chris says it's not an investment. I'm sorry, I have to disagree. It is. Fabiola says it's a waste of money. You get addicted and you do it every day for, well, I don't know. Anything could be an addiction. I'm a workaholic, so I'm addicted to work. Anything could be an addiction. So I don't know if that's a waste of money like that. But I'll explain why it could be considered a waste of money. Unless you do it often and buy more than once. If you use a lot of money, it's a high risk. No. See, this is the misconception. Here's what I want you guys to understand. Depending on how much money you have to, exactly. This is what I need you guys to understand. It's a high risk investment. It's a low cost of entry because you're only putting $2. But how often do you get a return on your money? Okay? What makes it a high risk investment or low risk investment or medium risk investment is the fact that you get some return, right? So if you go to work and you do your 2 weeks, whatever it is, like if you're paid weekly or bi-weekly, you do your time, you get your paycheck, right? So low risk, unless the company goes out of business or lays off or fires you, it's pretty much guaranteed. It's there. You worked, you get paid, right? The gambling portion of it, is you put $2, it's a low cost of entry, but the chances, the odds of you getting a return on that money, they're slim to none. So tough. Real estate, however, as an example, what you guys are doing here right now. Real estate is in this scenario, the license itself, it's a medium risk investment. It could be low risk, it could be high risk. Traditionally, it's medium because you only come in with less than $300 or $400 to get your course done. Then you do the fingerprinting, you activate your license, $160, so you're at $500-600, right? Then you get your MLSs and National Association of Realtors. So let's say in total, in your first year, less than $1,000. And you're already playing. You can do whatever you want already. Less than $1,000. Now, where does it go from medium risk to high or low? Well, remember when I said in a relationship there's 2 big variables, and those variables are people? Well, you're going to be in a relationship with your business. And the biggest variable in that relationship is you. What changes from a medium to low or high risk investment is you. It'll be a low risk if you put in the work, as I said yesterday, when you're consistent, persistent, and you don't give up, it'll be a low risk. If you treat this just like some of you might be treating the class itself, right? And I'm not saying you are, but I'm just putting it out there. If you treat it like some of you are probably treating the class, where, hey, I got this, I can be doing whatever, and I don't have to study. At the end, I'm going to cram, I'm going to do it all, right? I know a lot of people that in school, that's how they were, but that was in school. That's a long time ago. It doesn't happen like that anymore, because now you have life, right? You have kids, you have jobs, you have responsibilities, you have this, you have that. So the cramming portion or strategy doesn't really work anymore, right? Barely anybody that I know that's been through my class for the past almost 5 years that I've been teaching, right? Barely anybody that I know gets to the last day, studies, and passes. No. You have to be consistent with your studying. You have to be persistent with your determination to do something with your life, if this is what you believe to be your change in life, right? So changing something from medium risk to high or low depends on you. Now, if you're talking about gambling, it's different because you have no control over it. You see what I'm saying? Gambling, you have no control over it. You could put $2, you could put $100, you could put $1,000, you could put $1 million, but you have no control over it. Here, you do. So investment, ultimately, that's what I was trying to get at. Ultimately, an investment is risk. The risk is determined by how much money you're putting in and what are the odds of getting a return. So to answer, Robin asked what was the right answer. To answer that, again, gambling is a low cost of entry, but a very high risk because the rate of return is minimal. Real estate could be low cost of entry, could be high cost of entry depending on where you're heading, right? But the rate of return usually is higher than anything else because it's secured by something. The only variable there, or I'm sorry, the biggest variable there is you. You guys got it? So when you take all the other variables and you know that it's up to you to make things happen, then you determine again what's medium, low, medium, or high risk. All right, cool. So with that being said, let's go into the fundamentals. Like I said, unfortunately, no investment is truly secure. External conditions change, and the investment itself can change as well. Even if you had nothing to do with it, the value does not remain constant. I was just addressing this. Risk versus return. So what determines if it's a low, medium, or high risk is the rate of return. How fast can you get your money back? Very important. Again, going back to gambling, you put money for years and years and years. One day you might get some money back. One day you might get a bunch of money back, right? But it's high risk because there's barely any guarantee to it. The general rule in investments is that the safer the investment, the more slowly it gains value, right? You work, you get paid, but it doesn't give you that freedom that you need, right? So low risk, usually low returns. So it takes longer for you to accumulate the money that you want. The more you want to gain, right, and more quickly, then the higher the risk of losing it, okay? How much do you want to earn? How much are you willing to risk to earn it? Reward in investing corresponds directly to the degree of risk. So everything I've been talking about right now. Miguel, absolutely no risk, no glory. Absolutely. But still, I'm a medium to low risk kind of guy. Well, there's people out there that are high risk gamblers. Let's go at it. I'm going to put $10,000 into this stock and it's going to rise like crazy, right? And if it doesn't, I only lost $10,000. I'm okay with it. I'll cry another day, right? And here comes your spouse and goes like, what? You used all our savings? Yeah, honey, don't worry about it. It's just $10,000. I'll work for a little bit more. Some people live like this, right? I'm not. I like to have things safe, right? I like to have safety nets. So different types of investments, just in case one thing goes down, we have the other. right? So that's very, very, very important. Management. Another aspect of investment is the amount of attention that you must pay to it to make it work. And I'm talking to you guys now, again, regarding your career. How much attention must you take or give to it to make it work, right? You can deposit cash in a passbook account and forget about it. You can use your cash to buy a business and then run the business yourself to make the asset grow and earn. How much do you want to be involved in managing your investments? These are questions. Robin, so can you risk at medium level? What do you mean? You're asking what kind of investments would be a medium risk? Is that it? Sorry, I'm a little lost on this on what the question actually meant. Okay. Yeah, there's medium risk investments. I'll tell you, for instance, real estate is medium to low risk investment because as we went over in appraisals, right, and when we talk about the real estate markets, it takes so long to adjust, right, that it's pretty much predictable. You guys remember the cycle, right? I talked about the cycle last week, and actually this morning I was talking about it again, where if there's a high demand, it's okay. So if there's a high demand, right, in a certain area, but low vacancy, high demand, then people come in to build more houses to meet that demand, right? So there's cycles to it. It's predictable. When there's too many houses, then there's high vacancy, low demand now. So they stop the construction, right? And that rinse and repeats. So real estate is a medium to low risk investment in that sense. It's predictable, right? Other types of investments are medium to low risk, in my opinion. Life insurance, Roth IRAs. These are safe investments and safe havens for your money as well, because later on, you might not have to pay taxes at all on the money that accumulated over the years, right? High risk investments is when you, some companies out there, and I'm not attacking any company or their strategy, but when we're talking about insurance, some companies out there say, hey, just get a term policy and invest the difference. The problem is you're going to invest the difference in a variable market, right? And if you are not that type of investor, like Jacqueline was saying here, depending on how much money you have, right? If you don't have that type of money for that investment of investing the difference into mutual funds or stock market, whatever, then it becomes a high risk investment for you. So everything has its own strategy. What kind of investor are you? And by the way, all of you are investors, right? All of you. Because if you wake up every day, you make decisions, right? Your decision to go to work is an investment. Your decision to come back is an investment. Your decision to go eat is an investment. And we need to manage it carefully every single day, right? There's a lot of risks all day, every day. What kind of person are you, right? And that should determine the type of investment you should get into. If you're aggressive, I can show you products that are very aggressive and you get high returns. But if you don't do it right, or considering market variables, you could lose it all. Are you down for that? If so, aggressive investments is the way we go, right? And that's the problem with a real estate consultant. That's the problem with an insurance or retirement consultant. They need to be ready to understand the type of clients they have and their financial needs. You understand? I cannot sit here and tell you, Robin, hey, this is the right medium risk investment. No, cannot sit here and tell you that. I can sit down with you and look at where you are right now in life and where you want to be, create a plan of how to get there. And if you agree with that plan, we go for it. If you want something more aggressive, I'll adjust the plan to be more aggressive. You want something a little safer, I'll adjust the plan to be safer. Just know that the returns will be totally different in each level. You guys understand? Thumbs up? Cool. All right. The other risk. The other risk of any investment, liquidity. Okay? What does liquidity mean? Being readily available. Liquidity means being readily available. Okay? You go into your checking account, do you have money there? I don't care if it's $1. My question is, do you have money there? Can you cash out that $1 if you go to take money from your checking account? You can, right? That's liquid. It's immediately available. If it's illiquid, right, then we're talking about real estate as an example. As much as it is one of the best investments ever, real estate, unless you take some sort of loss, real estate is not liquid. The money is there, but can you tap into it tomorrow? No. It might take a couple weeks, it might take a couple months before you can get the money that's there. You guys got it? So liquidity is your money or investment being readily available to cash out. All right. Now, the basic aim of financial investments is to increase one's wealth, to add value to what you have. And notice the difference. Financial investment, because I told you there's other investments. But the basic aim, or the reason why we do financial investments, usually is to increase our wealth. Now, this can occur in several ways. We have income, right, which is an investment that's going to keep on generating some type of income on a periodic basis. So you can rely on, okay, I'm making $200 every month here, $300 every month there, $1,000 every month here or there, or whatever. Okay. So for instance, my partner and I, we have different pools where we keep on collecting every single month. We keep on collecting money without even thinking about it. It just comes in, right? And that's aside from real estate. So you should always look at different investments that bring you that type of return on a regular basis. Appreciation, it's not income, it's future value. Appreciation is, I bought something today, and 5 years later, it's worth more, right? It's worth more than what I bought it for. 10 years later, it's worth more than what I bought it for. So it appreciates or gains value over time. Depreciation, not here, but I'm going to take advantage of this point right here. Depreciation is the exact opposite. Like a car. As soon as you drive it off a lot, what happens? It depreciates, it loses value. All right? So to address that real quick, if you guys ever go to the student portal, let me show you real quick. The student portal, I mentioned this in I mentioned this in the first day. So let me show you. Okay. I mentioned this in the first day, and I'm going to show you again. If you guys scroll down, it says recommended books right here at the bottom, right? And the second book that's right here. Oh, sorry, right here. Second book that's right there is Rich Dad Poor Dad, and it'll change your mentality when it comes to appreciation and depreciation. See, most people work 40 hours a week for 40 years to then make 40% of their income. That's the reality, right? Because that's Social Security. And then you buy stuff that loses value over time. With Rich Dad Poor Dad, you're going to learn to make money work for you, okay? With Rich Dad Poor Dad, you're going to learn that for every depreciating asset that you want to get an appreciating asset, all right? So get something that increases over time, right? So then you can buy something that decreases. So you kind of like offsets. You want a car, buy a house first. The same money you're going to put down for a car, you might be able to save a little bit more and buy a house that gives you that $500 payment to pay the depreciating assets while still increasing in value. Does that make sense? You want to go on vacation? Think about it, especially now. Me, for instance, a family of 6. So 2 plus the 4 kids, 6. If I want to go on vacation, all of us, it's almost 10 grand. Buy a house. right? Buy a house that generates the income for me to keep on going on vacation. You see what I'm trying to get at? Right? We don't need fancy cars. We don't need fancy clothes. We need to buy stuff that will allow us to eventually have the fancy cars and have the fancy clothes. But people get out of school and I get my first job, I got my money, now I can spend on this, I can spend on that. Wrong. Learn how to make money work for you so you can have the stuff that doesn't work for you. All right? And once you get into that, train of thought and follow that pattern, you'll realize that, hey, I really don't need that Mercedes. Nope. I really don't need that Louis Vuitton bag. I really don't need this. You're going to start realizing that what I need is to keep on increasing this so I never depend on an employer. I never depend on a boss to tell me what to do or not to do, right? And for the past almost 16 years, I've been very happily unemployed. You understand what I'm trying to say? Unemployed. I don't depend on a boss to tell me what to do, what hours to make and whatever, or not, right? Has it been everything beautiful over the past 16 years? No, obviously not. There's ups and downs. But I control what I do or don't do, okay? I don't go to work, as it happened to me 16 years ago, I don't go into work for them to tell me, hey, Bruno, I'm sorry, go home, you're done, right? This happened to me. I worked so hard for a company back then, so hard, saved them millions of dollars in the position that I was in, negotiating bills for them. It was an insurance company. I was negotiating with the toughest attorneys, and we were beating them at every corner because of the detail that I was getting from the medical bills, right? And the police reports and all that stuff. What was their thank you? We're going to let you go. Right after I had a car accident, so it couldn't work, right? Right after I got separated. So, hey, I'm by myself now, and what am I doing? I completely lost. And this was a thank you. That 1 year right there, that 1 year, made me change my life, making me make a decision with my life. And that's where I started going into these types of programs, and that's why I am where I am today. All right. Jacqueline Johnson on YouTube. I read it, just bought the 20-year anniversary. There you go, the 20-year anniversary edition. Perfect. Glad you did, and I hope you enjoyed it, and that helped change your mindset. Okay? But definitely get that. That's just one of the books that I do recommend, and it falls greatly into this chapter. The other thing is this. Okay? Cash flow game. It's from the same company, Rich Dad Poor Dad. And again, I'm not advertising this because I make money out of it. I do not make any money out of Rich Dad Poor Dad's publications or anything that they promote. I make no money out of it. But I found this to be a great game to help you. It's like Monopoly on steroids, right? If you guys ever played Monopoly, right, to learn about real estate investing, this is the same thing, but like times 100, okay? Because it includes in those little cards that comes like in the Monopoly, it includes, hey, you just got a baby, so now you have to pay this. Hey, there's stock available, would you like to buy it? And then later on it tells you, hey, stock lost value or gained value. Now you have a 3-family that you can buy, and the rents are this and the rents are that. Now you have to fix this, you have to fix that. So it's Monopoly, but like I said, on steroids. It's like real life application, right? Monopoly is real life application, but very superficial. This is more specific. It's a great game to get out of the rat race, as it says. What is the rat race? Work 9 to 5 for somebody else. This will help you. I believe the concepts of this game will help you become financially free. Once you understand how to play the game, you'll understand how to apply it in real life, okay? So, appreciation. And that brings us to leverage, which is another thing that's talked about in that book. Leverage. What is leverage? What is leverage? If you guys know the word lever, you should know what leverage means. It means I have a big rock to move, and with a small rock and a stick, I can leverage it, right? The weight, so I don't put all my weight into it and not move. So I'm going to leverage it to move, right? So you're going to use a small portion, the same thing as going to a bank. I want to buy this house. The big rock is the house. It's $300,000. I only have $20,000. If there's a lender that allows me to put $20,000 down payment in order to buy the $300,000 house, then I'm leveraging my money and their money in order to get what I want. Does that make sense? So that's another part of investments. That's why I said everybody is an investor right now. So leverage, again, is where you're pledging the value of your resource to borrow funds in order to make an investment that is larger than what your own resource permits you to do directly. Okay? Leveraging, us getting together, everybody puts $25,000, right? We have 23 people here. Everybody puts $25,000. We're almost at $500,000 to buy something. Did we need the bank? No. But if we want to buy a $1 million or $2 million or $10 million building, a 100-unit apartment building as an example, between all our efforts combined, we leverage each other's resources in order to accomplish that goal. All right, so leverage, using what you have combined with what somebody else has and making the deal happen. Tax benefits. Okay, every investment has its own tax benefits, except for one. It still has tax benefits, but very limited. There's one investment that has a very limited tax benefit, which is your job. Okay. If you guys remember, there's different types of tax structures that we can create. There's sole proprietor, there's general partnerships, there's limited partnerships, there's corporations, LLCs, and so on. All of these business forms of ownership of anything, they give you tax advantages. Real estate, it has tax benefits for investors. For a homeowner, even though it does have some type of tax benefit, is not the best one. Okay, it is some, it's not all of it. So for an investor, we can use for instance maintenance, material that was used to fix something as well. So between labor, the actual maintenance of it, we can use that as tax deductions in order to reduce or defer amount of tax owed. It has a great tax benefit. If you're the homeowner, you don't have the same benefit. You cannot say, hey, I fixed the toilet, it cost me X amount of dollars, can we deduct this? As a homeowner, no. As a homeowner, here's the advantage you have as far as tax benefits. As a homeowner, you can deduct interest paid on your mortgage, right? As an investor, you can deduct the interest paid on mortgage. You can deduct the maintenance on your property, any losses that you might have had aside from maintenance. All that gets deducted as an investor. Okay. All right. Questions coming through. Oh, I'm sorry, I didn't see those questions. I'm sorry, guys. The name of the game is Cash Flow Game. Cash Flow Game. Is it good for kids? They have Cash Flow for Kids, and yes, I bought it for my oldest. The other one's still not quite there. The other ones, they have the Game of Life, which is very similar but simplified for the younger generation. But for teens, there's a cash flow game for teens. Erica, are you playing with real money or just a game? That's up to you. You want to play for real money with your friends? That's called gambling. If the police show up at your door, that's your problem, not mine. But it's more for you to understand the rules of economy. Stephanie M., what if your house is an LLC? So the ownership of the house being an LLC. Got it. The question is, Are you a tenant of the LLC, or are you the owner of the LLC, or are you the owner of the property that has a mortgage under your personal name and happens to have a deed under an LLC? Right? You don't have to answer this. What I'm trying to show you is, depending on how you structured yourself, because there's a lot of people making this mistake. They get financing under their personal name, but then they switch the deed to the LLC. Well, putting it under LLC but still having a mortgage under your name really doesn't help you for tax benefits. It helps you for shield, for the liability. If somebody sues you, they see the LLC, they don't see you directly. Does that make sense? But the mortgage still is your own personal guarantees, your own personal liability. For tax purposes, how does that affect you? You'll need to consult a CPA and see how you structured it. Okay? But could it? Yeah. Start paying rent. So instead of making payments out of your pocket, that's what I was trying to say, make payments out of the LLC. That's one of the ways to do it. Then you are a tenant, and the LLC is the one responsible. So then the LLC is the one that does all these deductions, and then you get a benefit on your primary taxes as well. So not the business taxes. Okay, and that brings me to another guy. I think I have here as well, right here. That brings me real quick to another guy, which is Grant Cardone. Now, Grant Cardone is the guy that created the 10x rule. Like, always do extra. Don't just do enough. Do extra. 10x all your efforts. If you really are serious about this, 10x all your efforts. Okay. So why did I bring Grant Cardone into this? He's one of the guys that talks about, not just him, but he's one of the guys that gets highly criticized about saying, do not buy a home. Buy houses, but do not buy a home. Meaning, never have anything under your personal name, because you can't deduct half of the stuff that you could as an investor. So either rent or buy everything as an LLC and pay the rent to the LLC. You understand what I'm saying? So how you structure yourself in your purchases makes a huge difference between success and failure. What was the other question here? So if you have a personal business and you work out of your home, you can turn your home into an LLC. Okay, now you're mixing things. You don't turn your home in the LLC. You change the ownership of the home into an LLC. Okay? Can your business own the home? Yes. How is it going to be seen? Depends on what the expenses are. What is the LLC paying for? Right? How is it structured? That's what I'm trying to tell you. That's why consulting a CPA is so important. You working out of your house does not automatically qualify your house as a place of work, even if you don't put it on an LLC. But you can deduct a portion of your home if you have a separated area just for your work. You can deduct a portion of your home for being used for business purposes. It doesn't necessarily need to be under an LLC. All right? So again, these are questions for your CPA based on your current situation. Not everybody qualifies for that. Especially because a lot of people think, oh, I put my laptop on my dining table and boom, I can deduct that space. Nope. For it to qualify as a deduction, it needs to be a completely separate space. Right? Anyway, moving forwards. Can you elaborate? I elaborated on a lot of stuff. I don't know what that question is. Elaine? Okay. I'll wait because you're driving, I see. Jeffrey, you guys still don't connect? Like, you can't tell me what her question is? Or she's too far to be able to transmit that? Okay. Moving forward. We talked about risks as well. Moving forward. Negative leverage, just talk about it as well. Money investments, debt investments. Okay, real estate investments. On page 274. Yours is 271 or 272. Okay, so real estate investments. A real estate investment is one in which an investor buys real estate for its investment benefits rather than primarily for its utility. As I was just saying, a home, it's for its utility, not for the investment side of it. It may have few features of both an equity and debt investment depending on the type of real estate involved and numerous other factors such as the type of interest that one owns. A real estate investor may invest in an income-producing property or a non-income producing property. A non-income producing property, right here, is a residential property used for the investor's primary residence. The basic reward, beyond the enjoyment of use, comes with the form of appreciation, so it increases in value over time. There may also be tax benefits, as I was saying, depending on how the purchase is financed, right? Because you can deduct, this already tells you, the only thing you can deduct here is the interest that you're paying the bank. An income property is a property owned specifically for investment rewards that it offers. Examples are multifamily residential properties, retail stores, industrial properties, and office buildings. The rewards come in any or all of the forms mentioned earlier: income, appreciation, leverage, and tax advantages. Do you guys understand why yesterday I focused so much on FHAs and VA loans that allow you to buy 1 to 4 families, and I said focus on the 4 families, right? Because these could be investment properties, right? Even though it's your primary residence to begin with, as soon as you move out, it becomes solely an investment property. And you got into it with the lowest amount of money, and you get the highest amount of value out of it, right? So like I said, income, so the return, immediate return. Appreciation, so deferred return, right? Leverage, because you can borrow against it, as we mentioned, right? And tax advantages. At the end of every year, you can deduct all your losses. Yep. Got it? So, appreciation property, non-income, or income property. Which one is the best to start with? It's up to you. My opinion, always income properties. Okay. Again, we already covered all of this right in the beginning. Now we're going to highlight, go in detail, as I usually do. And real estate investments participates in the general risks and rewards of all investments. However, real estate investments are often complex. They're also distinguished by their lack of liquidity, as we mentioned earlier, right? And by the amount of management that they require. So if you invest in stock, your management is just paying attention if it's going to go up or going to go down. Simple. Like, there's not much more you can do about it. When you invest in real estate, the amount of management is, what is the market doing? Going up, going down? Toilet that's broken, we need to fix it. The light that's broken, we need to fix it. The AC that's broken, we need to fix it. So there's a lot more things that come with it. Do I want to fix it? Do I want somebody to do it for me? So a little bit more complex than investing in stock. Now, in addition, each investor specifically aims to and circumstances that affect the viability of any particular real estate investment for that individual. Licensees, I think I mentioned this right at the beginning. Licensees who lack experience or expertise in the area, right, of investment analysis should refer potential investors to a competent advisor. Nevertheless, a licensee should be familiar with the basics of an investment. So, as we started off, this chapter is not the in-depth how to invest in real estate chapter. It's learn the basics, how to analyze something to see if it's a good deal or bad deal for your clients. If you do not know, bring your clients to somebody that knows how to do this and just understand the basics or learn as you go so you become the expert and don't rely on anybody else. Capital put into real estate is always subject to the full range of risk factors, market changes, income shortfalls, negative leverage, tax law changes, and poor overall return. So We talked about this stuff too. Market demand for a specific type of property can decline. I was just talking about this morning and for you guys last week, which is I'm in an area, for instance, that commercial and industrial are not the hottest thing right now. Commercial is still hotter than industrial. Nobody wants to open manufacturing here in Newark. Some businesses are moving into Newark, but mainly residential. That's what we have. That's the biggest growth that we've had here in Newark lately, right? So you need to understand that market. As soon as the residential market is saturated, what's going to happen? Either everything else comes or new construction comes in to satisfy those needs, right? Nobody's going to put a business in a place that doesn't have people either. So we need to understand the demands for specific properties in specific areas. Okay. Another risk of an investment property is the cost of development or operation. If startup costs or ongoing operating costs exceed the rental income, then the owner must dip into additional capital resources to maintain the investment until the income increases. So this right here is, and we're talking about investments, so it goes into residential, commercial, and so on, right? But this right here, if I open up a business, most people should be ready for 6 months to a year without any income. If you have that mentality, then you'll know you need to have money for inventory, you need to have money for employees, you need to have money for marketing, and you need to have money to pay the rent for the next 6 months to a year, right? If you have these, you're good to go, jump. If you don't have these, or you don't have anywhere to fall, right, onto it, like having a friend that will participate or a lender that will help you, right? If you don't have these, should you go into business? Probably not, because 9 out of 10 businesses fail because they're poorly prepared. 9 out of 10 businesses fail because they're poorly prepared. And then the return they get is not enough to maintain the expenses. If income does not rise, if costs do not decline, the investor simply runs out of money. When you get into real estate investment, the scenario is exactly the same. When you get into real estate investment, I see a lot of people, oh, the house is only $60,000. It's destroyed. It's $60,000. I can borrow money from an investor and fix the property, sell the property. No problem. Yeah. Just remember, there's variables. You can do that, but if $60,000 is all the money you have, what about if there's an emergency that's not calculated into that financing that you obtain, right? What if there's an emergency? What if you thought it was $20,000 to fix, but in reality it's $40,000? The investor only gave you $20,000, as an example. So you have to be ready for these contingencies. That's what these are, contingencies. Don't go into any business without being ready for that, okay? And again, 9 out of 10 new investors, same concept, 9 out of 10 new investors fail. Why? Because they go to this get rich quick type of seminars out there that teach you how to flip houses and do this and do that. And then they take your money, right? Not that they steal it from you, you give it to them. But then they take your money knowing that's probably the only money you have. And then you need to go to the next step and you give up. You give up because you were not ready for it. And what happens to your money? Did we say non-refundable? Some of them say refundable with a few clauses. I'll give you all the money back if you show me that you actually started going through the modules and you took action. If you did not, then it's not our fault. We don't give you the money back. And again, most people just give up. All right? And I have a lot of stories of this from students of mine over the past 4 or 5 years. Students that say, hey, I put $20,000 into this program. I put $10,000 into the program. I maxed out my credit cards to get into that program. All right? How many houses did you flip? None. How many houses how many wholesales did you do? Just flipping contracts? None. All right, but you still have access to the program, right? Yeah, it kind of expired. So you just gave $20,000 and $30,000 for nothing. Yeah. Did you at least log in? Yeah, I logged in. I saw what was there. right? So remember, variable, the biggest variable, people. Not taking action, people, all right? So don't go out and put money, and that's why I stopped here. Don't go out and put money into something if that's all the money you have. Okay, that's a big mistake. If that's all the money you have, if you have no other recourse, don't put all your money there. Okay, so leverage, what I was getting into, is a constant risk in real estate investment. If the property fails to generate sufficient revenue, then the cost of the borrowed money can bankrupt the owner. Exactly what I was just talking about, right? Just as development and operating costs can. Investors often overlook the fact that leverage only works when the yield or return exceeds the cost of borrowed funds. So here goes the ROI that Stephanie M wrote before. Whatever it returns on your investment needs to exceed the costs. If it doesn't, you're always going to run out of money. Tax law, the reason why I tell you to go to CPAs. Tax law is an ongoing risk in long-term real estate investments. If the investor tax circumstances change, or if the tax laws do, the investor might end up paying more capital gains and income taxes than planned, undermining the return on the investment. So it might look, right? There's some things that might look that it's giving you a great return, right? And then depending on what tax bracket you're at, you're going to pay different amounts of taxes. So there goes all your profit, right? Skipping from real estate into salesperson position. You're going to be 1099. 1099 is almost the same thing as this. For tax purposes, a lot of people receive the money, in my example, a lot of people receive the money from all the sales they've made, and they think that's it. And they waste the money. Or calculate, well, this is my tax bracket compared to this type of investment. This is my tax bracket. I only have to put this much to the side. And then next year, you go above a certain tax bracket. That's it. The money you put aside is not enough to satisfy. Or you don't have enough deductions. Or you didn't register every single deduction, whatever it might be, right? So CPA, very, very important for you as an agent, for you as an investor, for you in general. Having a tax professional can help you save a lot of money. Or, not going political, or making billions of dollars and only paying $750 on your taxes. So just saying, having the right CPAs does help, okay? An investor needs to consider carefully the value of such potential tax benefits as deductions for mortgage interest, tax losses, deferred gain, I already explained all this, and tax credits in certain types of real estate investments. Another consideration for investment is opportunity cost. Opportunity cost. Opportunity cost is the return that an investor could earn on capital invested with minimal risk. If the real estate investment, with all its attendant risk, cannot yield a greater return than the investment elsewhere involving less risk, then the opportunity cost is too high for that real estate investment. So, despite all the risks, real estate remains a popular investment because, historically, the rewards have outweighed the risks. Real estate has proven to be relatively resistant to adverse inflationary trends that have hurt money, debt, and stock investments. All right? So why do I believe real estate is like the greatest investment ever? The risks. You have something to hold on to. It's slow market, right? So slow adjustments. We got that. Very easy to understand. Okay? And even with the downfall that we had in 2008, 2009, right? Even with that downfall, if you guys look at the historic, as I said here, for the past 50 years, but if you guys look at the past 30 years, forget the 50 years. If you look at the past 30 years, even with that huge drop, right? The values were still like this. It went up, huge drop, and then right back. So no matter what, here, I know it doesn't look like in what I drew, but here it's still valued higher than it was over here when 30 years ago, right? So no matter what, real estate is always increasing in value, okay? So understand cycles. We talked about this several times. Understand cycles, but real estate, except for this 2008, 2009, real estate traditionally has these ups and downs, okay? But as you see, always increasing in value, okay? Very, very important. Not like stock market. Don't get me wrong, love stock market. Not for me though. I love stock market because it helps me design my real estate investments actually, and helps me design my retirement planning for insurance. Love stock market. But the problem with stock market is that we zoom further in, okay? And the same thing that we see here like this segment, let's say this is 1 month, the same thing we see here in the stock market is going to be this. Very erratic. So yeah, no. Predictable right here, somewhat predictable if that's all you dedicate yourself to. But here, almost anybody can predict what's about to happen. You guys got it? I'm not trying to say this is what you should do only. That definitely not. But this should be one of your priorities, is always investing in real estate. Now, as we said, illiquidity. Compared to other classes of investment, real estate is relatively illiquid. That means you might have to lose money. We talked about this. You might have to lose money if you need to cash out. So I'm going to skip this. I already talked about comparing to drawing money out of your bank account or selling stock. Real estate investment entities. Real estate investment entities. So we're going to start with direct, and this is individuals. We already covered all this in the previous chapter. The only thing I did not cover was syndicates, pretty much. I briefly talked about syndicates, and here we're going to go more in detail. But you have the direct investment where it's you as an individual, corporation, or other investors that may invest as active investors in the property. So you're actively taking responsibility and managing the property. Syndicates and partnerships. A real estate syndicate is a group of investors who combine resources to buy, develop, and operate a property. We talked about it earlier, right, in the previous chapter. A general partnership, we share the liability. We all, it could be a syndicate, right, where we all participate in an amount of equity and we all manage the property. But we also share the liability, right, the profits and liability. If we get sued for $1 million and only one of us has the money, well, we're general partners, so we share the liability. One of us will pay for all of us. Simple. In the limited partnership, we have the general partner, at least one, and then we have the limited partners, which are passive investors. Passive investor means you sit back, relax, and let the money come to you. The active investor is the one that it's right there working in the trenches and making sure it brings all the money for me as a general partner and for my passive investors, limited or silent partners, okay? A REIT or real estate investment trust. REIT or real estate investment trust. In the real estate investment trust, investors buy certificates in a trust, and the trust in turn invests in mortgages or real estate. Investors receive income according to the number of shares that they own. Now, a trust or a REIT must receive at least 75% of its income. Look right here. Must receive at least 75% of its income from real estate in order to qualify as a REIT. Okay? One of the things that doesn't say here is you got to have at least 100 investors. Has to have at least 100 investors to qualify as a REIT, and 75% of the income must come from real estate. So if the question in the state exam says, for instance, there's 83 investors, but 100% of the income comes from real estate, this could be what? And then gives you 4 options. General partnership, limited partnership, could be a REIT, could be a syndicate, whatever. Okay? Or the question will be, could be all of these except. So based on what I told you, all of these except, based on what I told you, it has 83 investors and 100% of the income is from real estate. Could this be a REIT? No, because it needs 100 investors and at least 75% of the income to come from real estate. Muslima, what kind of certificates? Like stock. So what is stock? Stock is a certificate to business earnings. Let's put it like that. In this case, it's a certificate to the trust's earnings. So the more certificates you have, the more you buy, right? The more shares you buy, the more you're entitled to in returns of that money. Okay. This one's not heavily tested. I don't have it highlighted. Okay, but a REMIC. It's a real estate mortgage investment conduit. And what we do with REMICs is more for the secondary markets where we purchase a pool of mortgages. Remember that? Fannie Mae, Freddie Mac, and all that stuff? They're in the secondary market and they purchase pools of mortgages that are secured by real estate. So that's a REMIC, real estate mortgage investment conduit. So we stay there and we wait for those returns. That's all it is. Any questions so far? Nope. Okay, cool. The next thing we got is taxation of real estate investments, taxable income, cost of recovery, gain on sale, interest, and passive activities. So we might stay here a little bit. Let's see. Real estate investments are taxed on the income they produce and on the increase in value or gain when the investment is sold. Now, these forms of taxation are distinct from ad valorem taxation, which is according to value. This is the general taxes. Right? So these are different. These are taxes for the town. The general taxes or according to value taxes. Right? This taxation is considered taxable income, so you deduct that from your personal taxes, not the payments you make to the city where you are. Taxable income from investment in real estate is the gross income received. The gross income received minus any expenses, deductions, or exclusion that the current tax law allows. So the taxable income is the total minus these things. That's what whatever's left is your taxable income. Now, the taxable income from real estate is added to the investor's other income and taxed at the investor's marginal tax rate. The investment analysis of income property section gives you more details, so we're going to get there. And then the IRS allows you something called cost recovery. We know this as depreciation. Now wait, did I talk about depreciation earlier? I talked about appreciating properties and I talked about depreciating properties, right? I said that a car, for instance, is a depreciating property. Can real estate also be depreciating? Let me know in the chat. Is real estate an appreciating asset or a depreciating asset? Could be both. Okay? Both. Depends. Jackie just says yes and yes. or both, I guess. Appreciating asset, but you can depreciate. So both. Okay, yes, could be both. Great. So it could be both. In fact, it is both. You know why? Because like I showed you before, yes, Jackie, based on upkeep and other factors, exactly. Like I showed you before, traditionally, real estate keeps on increasing the value over time. So there's appreciation, constant appreciation, right? What you are entitled to deduct from your taxes is the life of the asset. What does this mean, life of the asset? Guys, we are born and eventually we will die. And in that period of time, we go from being a baby with barely any problems to growing older and having more and more problems, and we need to fix this and we need to fix that, right? Just the way it is. So there are certain items in our body that eventually die and need to be replaced, like a knee replacement. Why would you do a knee replacement? Depending on how you use it. We go back to real estate, is the same thing. I have a wall. Is it possible that eventually I need to replace this wall? I have pipes. Is it possible that eventually I need to replace the pipes, the electrical equipment, the roof? Is it possible that eventually those need to be replaced, or are they going to last forever? Right? So that's what it's called, life of the asset. And for that replacement, like Jackie was saying, the upkeep and other factors, for that replacement, we have a cost. The IRS allows us to recover that cost. So we can deduct for depreciation. IRS allows us to deduct for depreciation of that loss over time. Okay? So we know you're going to have to fix something, right? We know that. So we give you a credit. In fact, the assets economic life has different established terms. For residential is one, for commercial is another. Now look at this. Remember when I said that if it's a home, you don't have the same tax benefits as an investment property? Remember when I said that? The cost recovery, the maintenance, the improvements is only allowed for income properties. So only income properties can deduct for that cost. Guys, make sure you have your cameras on. Whoever's doing this for the first time, this chapter, if you haven't done it before, keep your camera on. Otherwise, Zoom will not calculate your hours the way we need. Okay? Okay. All right, so cost recovery, depreciation applies to improvements. Land cannot be depreciated. Wait. What do you mean? What does this mean? Applies to improvements, but land cannot be depreciated. What does that mean? Anybody? What does that mean? Value can't go down because you can always improve on the land. All right, so I like your explanation, Stephanie. Perfect. Value can't go down, but let's elaborate a little bit more on that. Let's see. Improvements are man-made things added to land, such as buildings. It's not movable property, okay? Because land can't be destroyed. Land can't, but what you build on it, you can. Improvements are man-made. Great question, right? If you're on an island and water erodes half of your property, get on a boat. Go to a bigger island. Great question. But what we're saying is right here is that land is land. Land cannot be destroyed. So yes, it could erode, but land is land. It's there, right? So it doesn't lose value because over time it needs to be maintained. Land is land. Could you lose land through erosion? Yes. But does it get destroyed because it got old? Not land. Improvements or anything added? Yes. Okay, because that's what we're talking about. Losing value over time because it needs to be replaced. This has cost recovery. Yvette, based on your question, how are you going to gain the land back? Okay, cost recovery, that means you're replacing something. You're replacing the improvements. Can I put a new building there? Sure. Can I make new land? No. All right? So that's what cost recovery or depreciation means for tax purposes. Only improvements, so the building or paving it or a garage or a pool or whatever you add to it, everything that's man-made, as we mentioned in the chat, right? Everything that's man-made or any type of human-made improvements is considered improvement for tax purposes. Land, as raw land, does not depreciate because it doesn't get destroyed over time. It gets altered, yes, but it doesn't get destroyed. Like, it's still there. What about like a farm where they go grow crops? How deep do they go? Right? You know what I'm saying? The land is still land. We're not talking, guys. If you remember, okay, no. Let me go here real quick. No, there's a cost recovery. Cost recovery to what you're adding to it. Okay, but hold on. Land is not just that line. Land is the surface, everything below and everything above. That's land. So we're not talking, you guys thinking about land as the surface. You guys thinking about this spot right here. No. If I plant for something to collect later, so crops, how deep am I going to go to get those crops running? Right? That's not it. What we're saying is land as raw land, as nature gave to us, right, does not depreciate, does not lose value. Anything we do to it, it's called an improvement. Anything you would do to it could lose value, and therefore you might be able to recover as a depreciating asset, right? If you have crops, like you're trying to write there, if you have crops, right, then that's a business. If it's a business, then you have a business loss. It's different than the building, right, or the structure that exists or was created for it. You guys understand? So different aspects of taxes. We're talking about real estate. We're not talking about the loss of business because it got damaged. Okay? Is that cool? All right. Okay. Next, we have depreciation schedules. Remember, I told you guys that that there's a term for residential and then a term for commercial properties that you can depreciate, right? So for Internal Revenue Services, the depreciating term or period for residential properties is 27.5 years. What does that mean? Over the next 27.5 years, you can deduct every single year for a loss in value, every single year. So right here it says 3.6%. You need to be an accountant to know the exact numbers. They're always changing. But let's make the concept very simple. I'm not saying this is what it is, but let's make the concept very simple. You bought something, it cost you to build $275,000, right? Over the next 27.5 years, how much can you deduct? Right? $10,000 every year. Just to make it as simple as it could be. It's less than that, but you are entitled to recover the cost because over the next 27 and a half years, that's what they determine to be the average life expectation of a particular item in the property. Okay? So the roof, usually they give you a 30-year warranty. Some other things in the property come with 10-year warranty because they know after 10 years it could go bad. When you start adding in the averages that it gives, 27 and a half, that's the expected lifetime of the whole house to be replaced eventually. You got it? So that's the number for residential. For commercial, it's 39 years for commercial. So non-residential income properties, 39 years. Don't worry so much about 39. You need to know this one. The question the state exam could be, for those of you paying attention without any distractions inside your house or outside your house, the question in the state exam could be, for instance, John owns this property for 29 years, right? He bought the property for $100,000 and now he put $200,000 into the property. How much can he deduct this year? Okay. Go ahead, answer, Erica. Since you're shaking your head, answer. The answer is nothing. Nothing. Because 29 years, yep, 0. 29 years is greater than the amount of years that he can deduct based on the IRS schedules. Got it? So if the question says 29 years, it's beyond, therefore 0. Guys, make sure you are on camera. If you're not on camera, 1, I cannot tell if you are actually in class. 2, Zoom cannot tell if you're in class. 3, if I have to review to see the amount of hours that you did and you're not on camera, it's going to be very tough for me to qualify you. Okay? Remember, you need to do, in the state of New Jersey, you need to do 75 hours. So I need to account for all the hours. You're entitled to miss 10%. If you are in Zoom, but you're not in the camera, or not participating, there goes your hours. Okay? And you have to do it all over again. And still not listening. Okay. Alrighty. It's on you, not me. How many more warnings can I give? It's tough. All right, next. When real estate, whether non-income or income, is sold, a taxable event occurs, right? If the sale proceeds exceed the original cost of the investment, subject to some adjustments, which I'll talk about in a second, then there's something called capital gain. What is a capital gain? Well, again, it's the difference between what you sold for, what you paid for it, or whatever you put in. So if the sales proceeds are less than the original cost of the adjustments, and there's a capital loss. An investor can sometimes defer the reporting of gain or loss, and hence taxation of gain, by participating in an exchange of like-kind assets. The legislation that deals with a like-kind exchange is contained in the section 1031 of the IRS code, and we call these section 1031 exchanges. Now, before I move forward, what is an exchange? Forget real estate. Forget everything we read so far. In the most simple form, what you know, what is an exchange? Trade. Okay? Transfer between two or more parties. Okay. Here you go. Simple. Because I can always trade up, right? So now, okay, now we're getting better. Switch one thing for another, or trade of equal value, or swapping something for something, right? It could be a trade. Guys, it could be a trade. It could be a transaction. It could be all of it. The keywords were, if it's an exchange, then it has equal value. Very important, an exchange. I give you something for something of equal value. That's an exchange. So here comes my question. If it's equal value, was there any gain? No. Was there any loss? No. So if there's an exchange, there's no gain, there's no loss, there's no taxes. You got it? If there's an exchange, there's no immediate taxes. And that's the advantage. That's the advantage of the Section 1031 exchange. The Internal Revenue Code allows you to exchange like-kind assets. So here's your investment property. Here's my investment property. You want to come to Jersey? You want to get my property? Let's exchange. I go to wherever you are. We exchange. As long as they have equal value, there's no gain or loss, right? As long as they have equal value, did I profit? I did not. I just switched with somebody else. Now, another thing that's in the Internal Revenue Code, 1031, is that they allow you to switch properties without having to find someone to switch with. Okay? Great question, Yvette. I'm getting there. So you can find another property without having to switch with somebody else. So to qualify under the Section 1031, there must have been a legitimate exchange of the assets involved. The property being transferred must have been held for productive use in a trade or business, or held as an investment, and must be exchanged for property that will also be used in the trade, business, or held as investment. So like kind. The tax on the gain, Yvette, the tax on the gain is not eliminated. It's deferred until the investment is sold or no longer exchanged. So yes, there is a future profit payment. The profit was now. Because even though we're exchanging for 500,000, did I buy for 500,000? No. I bought it for 100,000. I put 100,000 into it, so that's 200. And I'm exchanging to you at current market value, 500 for 500. But I had a $300,000 profit. What I'm doing is, instead of paying taxes on the profit, the immediate profit, instead of paying taxes, because I didn't tap into the profit, they allow me to roll into the next property and pay taxes only when I sell this second property, right? If I have a loss of $300,000 on my second property, then how much do I have to pay in taxes? Well, $300,000 gain and then $300,000 loss offsets. So it would be zero. You got it? Well, technically, it would be zero. You guys understand? So one of the strategies you guys are going to learn from some of the books that I have there in the library, one of the strategies you're going to learn is to defer, 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 and die. If you follow this pattern, if you keep on deferring your taxes by rolling over to the next property instead of cashing out, roll over to the next property. If you keep on doing this, then you'll die without having to pay capital gains. Simple. Eventually, you will. So be prepared, because you will die. I'm sorry, it's the law of life. But just be ready for it. You want to avoid taxes? That's it. Will your heirs have to deal with it? That's a different story, and that's why you should prepare for it as well. Uncle Sam always makes their money. Not always. There's legal and lawful ways to avoid it. Okay, make sure you always talk to a CPA about it. Verona is asking, is this a common transaction? I've never heard of this. My question to you, related to the second part of this question, my question to you, Verona, is very simple. Out of all the stuff that you've learned so far, we're on chapter 18, out of all the stuff that you've learned so far, you knew 90% of it? 80%, maybe 60%, 50%. How much did you really know? See, the problem is, as I said, the level of education that we get in school is not enough. He didn't die yet. He didn't die yet, so no, that's not what it is. It's a little different. I'll explain in a second. So yeah, is this a common transaction? It is. It is. Actually, if I'm your realtor, right? If I'm your realtor and I'm helping you sell, that's one of the advices I'll tell you right now. Hey, listen, you should, before closing, start looking already for the house you want to buy. Because as soon as you're done with this, you should roll over to the next property so you don't pay capital gains. Simple. So is it common, depending on the type of realtor you have? Yeah, they'll explain to you how not to pay taxes legally and lawfully. But let's consult a CPA before we do this. Absolutely. How many people actually remember this once they get out of class? I don't know. Probably none. Maybe as soon as you deal with a situation, somebody mentions, oh, 1031 exchange, or you'd be like, heard of that before. Don't know exactly what it is, but I've heard about it. But anyway, is that what the president did? So Stephanie M. The president did a combination of things. Okay, the president did a combination of things that was allowed by the Internal Revenue Code, and a lot of things that we still do not know, and a lot of things that unfortunately could be deemed illegal according to the Internal Revenue Code. I'm not going to say that it's right, that it's wrong. I have no idea because I'm not the one that's overseeing his taxes. But it's not just the president. All these big people. Look at Jeff Bezos with Amazon. He hasn't paid taxes at all, and he became like he's not a trillionaire yet because we don't allow him to be yet. You see what I'm saying? He made almost 40 or almost $50 billion more since this pandemic started, and he still did not pay a single cent in taxes. It's knowing the codes. He reinvested in the business. Instead of taking profits, he kept on instead of taking profits, he just dumped it right into the business. So did he have gains? No. Right? So it's a matter of knowing the strategies. It's very similar. Just roll over into something else. What the president did on a couple of his businesses, which a lot of people do, is bury the business in expenses. So was there profit? If there's no profit, how can he go towards you personally, right? So those are things to consider. But for real estate, besides certain comments here, no, we're not finishing early. Plus, it's not the presidential debate; it's the vice presidential debate. Anyway, this one does not stutter, so I don't know what's going to come out of this one. Let's see. By the way, again, not getting political here or one side or the other, but the Republican strategy is great. Confuse Joe Biden because he has a stuttering problem, so it's easy to distract him. Yep. Oh, there you go. Kevin. Who cares? Not important. Real estate for the win. Love it. Perfect. Exactly. All right. Ready? What you should care about is learning the strategies that these big billionaires use and apply it to your life. So again, having the right CPA is very, very important. How they do it, is it legal or is illegal? To me, it really does not matter. What matters to me is my life and what I do with it. Because nobody ever, I haven't seen one president, one congressman or congresswoman, Senate or whatever, I haven't seen anybody come down to my house and say, hey, Bruno, how are your bills doing? You need some help? Let me pay your bills for the next year. Nobody. Okay? So, I know what I'm doing for my business. What are you doing for yours? Okay? Back to this. Sorry, that was just the commercials. So now back to back to by the way, in real estate, don't mix politics with your business. Very, very important. Do not mix politics with your business. You're gonna lose. You have a 50-50 chance of losing customers. Just saying. So in real estate, you are not Republican and you are not a Democrat. You're not any other party. You are a realtor. Simple. Mortgage interest. I already told you that mortgage interest, whatever you pay them, is deductible. Okay? The principal payments are not deductible. Mortgage interest is deductible, and this is for investments and as well for residential. Mortgage interest is deductible. That's all you need to know. Mortgage interest is deductible. The payments of principal is not deductible, only the interest. We did talk about limited partnerships, and I said that if you're a limited partner or silent partner, then how much do you have to lose? You only have to lose whatever you put in, right? The same way for taxes, for tax purposes, you can only offset that passive loss, you can only offset with other passive activities. So you're limited in several aspects. Your investment and the power that you have to voice yourself in the business. Your loss, if you get sued for $1 million in that business, you only lose whatever you put in. And for tax purposes, your passive losses can only be deducted from passive, other passive activities. So let's say there's active gains and there's passive gains. And by the way, there's no direct relation to this. I cannot tell you the exact numbers. Again, a CPA will be very important for your situation. Okay, and then we have active losses, and you have passive losses. Okay. Now, if you have passive losses, that's what I was trying to say. You're a limited partner, so you're not actively involved in the business. If you have passive losses, they can be used to offset passive gains. So let's say I have a passive investment, I make $100,000 on it. I have to pay according to my tax bracket, whatever it might be. I have to pay based on that. Here, passive losses, if I lost $20,000 somewhere, I can offset how much I would have to pay based on this. In this one, let's say we're talking about your wages, your salary. You make $100,000 a year. You're going to pay $30,000 or $40,000, let's say, in taxes. Just throwing numbers out there, right? Can you use the $20,000 loss here to reduce the tax burden you have from your active losses? And the answer is no, because it cannot go any further. Right there, no. There's a barrier. No. Passive losses against passive gains. Active losses against active gains. Passive and active, the difference is how do you participate in that investment? Okay, wages, it's easy. You work for it, right? It's you, it's nobody else. So that's wages. If you have a business and somebody else does the work, you're just sitting back relaxing, then whatever other people do gives you passive gains, right? So make sure you understand losses from such activities may be used to offset income from other passive activities. Next, we have investment analysis of a residence. We have appreciation, deductibles, tax liability, and gains tax exclusion. We're going to start with appreciation. In other words, job helps? Nope. Not really. You could be active in a business. If you're an independent contractor, like a real estate agent, you have active wages, right? You have active income, but you also have active losses, right? I buy this, over time I have to replace it, so there's a loss. I had to buy a uniform. I had to travel, right? So these are direct, it's active. I use it for business purposes. You got it? So the active income, active loss. And Jackie just went, oh God, math. Yes, we have some math coming. Yep. Erica's about to run away too. Stay here, stay here. Okay, all right, cool. Appreciation. See, and she left. Appreciation is an increase in value of an asset over time. A simple way to estimate appreciation on a primary residence is to subtract the price originally paid from the estimated current market value. So current value minus original price is the total appreciation. This one is very, very easy, right? If I bought the house for $300,000 and the current market value is $400,000, how much did it appreciate? How much did it increase in value? $100,000. That was the appreciation. That's what helps us, for instance, get that HELOC we talked about yesterday, right? There's equity. If the question in the state exam was how much did it appreciate, or what percentage did it appreciate? Well, it's easy. It's 100,000, whatever it appreciated, right? Divided by the original investment or the original price, and it appreciated 33%. That was a 33% increase on your investment. Not bad, right? That's a good, great return on your investment. Okay. Can we complicate things a little bit? That was easy, right? Everybody's good with this one? Yeah? All right, cool. Jackie, are you good? Sure. What page? Well, mine is 279. Yours, it's either 277 or 276. You guys tell me whoever has the book right now. What page is it? 278? Okay. Okay, page 278. All right, to estimate a percentage of annual appreciation, we divide that percent appreciated over a number of years that the house has been owned. So a percentage of appreciation divided by years owned gives us the percentage of appreciation per year. So in this case, if we owned it for 3 years, we had a return of 11% a year. That's just on appreciation. We're not talking about your monthly income. We're just talking about it's okay. Yeah, the numbers are a little bit different, but the concept is exactly the same, Jacqueline. The concept is exactly the same. So mine shows 33 right here, 33%. This is what you have there for 20%. Numbers are a little bit off, but everything else is the same. As you scroll down, everything else is exactly the same. Just the numbers are off. All right. So the primary tax benefit of the owner of a non-income property non-income property, that means, for instance, your residential, right, property, is the annual deduction of mortgage interest. As I said, the only thing you can deduct is interest. So, okay, Muslima has a question. I thought it was a real question. So question, are those Zillow property values estimate accurate? Here's my question. Question number 1 towards this. When was the last time Zillow went into your house? When was the last time that Zillow checked how your basement was or how your attic was? How much space you really have? See, Zillow relies on public data, and if it's not listed, then we don't have nothing to compare to. In fact, I challenge every single one of you, as I've been doing for the past almost 5 years in the same class, same real estate class. So ask the same question, which is, go there and check your property. If your property is a single family, it will show single family. If your property is a multifamily, right, let me know what it shows there. Simple question. And that will tell you if it's accurate or not. Okay? Augusto. Okay, I just received a message here. Great channel. Thanks for the content. I'm getting ready to take my state exam. You've been very helpful. Listen, if it helps, I'm very happy. If you have questions, make sure you always drop the questions here during the lives, and I'll be able to assist you, okay? And I don't know when you're taking your state exam, but good luck. And I'm glad I can help. All right, so Muslima, did I answer that? Cool. All right, so next. The seller, you're welcome. So the seller of a principal residence may owe tax on capital gain that results from the sale. The IRS defines gain on the sale as a home of a home as the amount realized from the sale minus the adjusted basis. Now, amount realized, it's not like, hey, I just realized that I did this. Amount realized is what was the amount that actually sold for, right? So we have the amount realized, again, is the net proceeds from the sale. That's what it sold for technically, right? Because there's gross sales price. That's how much it sells for, minus the closing costs, cost of the sale. So that could be with commission and everything, right? So how much did it actually sell for? This is the amount realized. All right, so it sold for 180. There's an example coming up, but just to right here. It sold for 180. We had $10,000 worth of commission, closing costs, and all that stuff. So how much did it actually sell for? Meaning, how much did I take home? $170,000. So this is the net sales price. That's how much I took home, 170. Was that my gain? No, because I put money into it, right? So let's look at that part. Amount realized is what we actually got from the sale. So what it sold, right? Now, the sales price is the total amount the seller receives for the home. This includes money, notes, mortgages, other debts that the buyer assumes as part of the sale. Costs of the sale include, like I said, brokerage commissions, relevant advertising, legal fees, seller paid points and closing costs. Certain fix-up expenses, as discussed further below, can be deducted from the amount realized to derive at the adjusted sales price. It's the second time I'm underlining adjusted sales price. For the purpose of postponing taxation on the gain. For example, Larry and Mary, don't ask me why, but Larry and Mary sold their home for $350,000. Their selling costs, including the commission paid, they paid the broker, Betty, and the amounts paid to an inspector, surveyor, and site title company amount to 10% of the selling price, or $35,000. So how much did they realize? How much did it really come to their pockets? $315,000. Because it's the sales price minus these closing expenses. How much did they realize? How much did they make? Was actually $315,000. Now, there's something called adjusted basis. There's adjustments to it. Okay? Adjusted basis. First of all, you need to understand what the word basis means. Ready? Cost. So every time you see the word basis, is how much does it cost? The adjusted basis, that means purchase price plus other stuff that we put into it. So fixing up the property. That's why, before I explain the rest, that's why I get very upset at some realtors when they're advising their clients to put offers. And they go like, well, but he only paid $100,000 for this house. What do you mean he's selling for $500,000? That's ridiculous. Offer $300,000 and we good. Well, basis was the cost, $100,000. What I really put in was the adjusted basis, $100,000 plus $250,000, $300,000, whatever it is to fix up the property. That's the real cost that you don't see in the records. You guys understand? A lot of people take this stance when putting offers. You only pay this much. You're trying to make a whole lot of money. No. I paid $100,000, but the house was, this is true stories, by the way. The house was destroyed. I had to put $200,000 into a house. So pretty much rebuild the whole house. Right? So don't come tell me what I can sell for. It's my property. And if I wanted to make $300,000, it's on me, not you. Put your highest and best, and we'll go from there. You got it? So a lot of people assume that that's what it is. So, how much is invested into the property for tax purposes? Assuming that the property was acquired through purchase, the beginning basis is the cost of acquiring the property. Right? So basis, as it stands, cost of acquiring the property. The costs include cash, debt obligations, and such other settlement costs as legal costs, recording fees, abstract fees, surveys, whatever the costs were to close. The beginning basis is increased or decreased by certain types of expenditures made while the property was owned. Basis is increased by the cost of capital improvements. So every time you make capital improvements, you got a new roof, great, $15,000. That adds to my initial investment. Okay, new siding, $5,000. That adds to my initial investment. Okay. But then we can also decrease the basis by any amounts that the owner received for such things as easements. You guys remember what easements are, right? Okay, cool. I get the nods of head, so that means you know. So the basic formula for adjusted basis or adjusted cost, again, adjusted cost is beginning basis, or simply basis, plus capital improvements minus exclusions, credits, or other amounts received, including depreciation. Okay, so including depreciation, we get to the adjusted basis or adjusted costs. So $100,000 plus $200,000 minus other credits I might have had, depreciation, whatever. What is the adjusted basis? It was 175 or whatever. So let's come up with a number, 175. Okay, so that's the adjusted basis. And here's the example. Mary and Larry originally paid $200,000 for their home. They spent an additional $10,000 on a new central heating and cooling unit, and their adjusted basis at the time of selling is therefore $210,000. If they sold for $315,000, then what was the capital gain? Well, capital gain on the sale of a primary residence is represented by this basic formula. Capital gain is the amount realized, so how much you got from it, right? The net sales proceed minus the adjusted cost, right? And that tells you what was the gain on the sale. That's how much money I really make. Okay? I know questions coming through, and I'm probably going to answer right now, but good. Faster, Yvette, faster. If capital gain improvements was made through an insurance claim, does it get calculated the same? If a capital improvement was made, did you get the money out of your pocket? Did it come out of your pocket? You placed the new roof through the insurance. Was that your expense? So the basis is based on expenses. Was that your expense? Okay. So that's what you need to figure out. Did it come out of your pocket? So that's not an improvement. That was a fixing of something, right? So it might not be added to the adjusted basis. Jackie's asking, can any of these problems be solved by using the wheel? Whatever involves a percentage, yes. If it involves a percentage, you can use the wheel. Percentage, rates, anything like that. Right here, no. This part, no. Yvette, 3 question marks, like 2 and 1. I don't know. Erica, what wheel? When we get to math. Well, you should know that. That's the steering wheel. Little circle, the T, the ninja face. Oh, you're not understanding my answer regarding the insurance claim? Again, why do you have an insurance claim? Because something needs to be fixed, right? Something was damaged and you activated the insurance. Did it come out of your pocket? Did the $100,000 to fix whatever it was come out of your pocket? So was it really a cost that you had? Probably not. Okay? It's an insurance claim. The deductible was your cost. Go ahead, put that into it's going to make a huge difference. All right, but again, your CPA should be able to help you with that answer. So, gain on the sale, if it does not qualify for an exclusion under current tax, and I'll talk about exclusions later, it's taxable. How is it taxable? Ready? Okay. You're back, right? Nirka's back. Okay, cool. So how is it taxable? We have gain on the sale, right? This is the selling price, $350,000, minus the selling costs, $35,000. Then how much did I take home? Net sales price. We took $315,000. This is the number we need to start our calculations. Now, we bought the home, so beginning basis. We bought the home for $200,000 and we put $10,000 into it because we chose to, not because there was an insurance claim, because we chose to improve the property. So extra $10,000. The adjusted basis is now $210,000. So these are the two numbers that we need. Amount realized or amount made was $315,000 minus the cost of this property, $210,000. What was our gain? $105,000. That's my real gain. That's how much I made over the years. So they will owe, Mary and Larry will owe tax on this amount the year of the sale unless they qualify for the exclusions described below. So if it's an investment property, you will not qualify for the exclusion I'm about to read. If it's residential, if it's where you live, then you qualify for this exclusion. So the tax law provides for an exclusion of $250,000 for an individual, $250,000 for an individual taxpayer, and $500,000 for married taxpayers filing jointly. Now, this exclusion means, in this scenario, if I'm single, do I have to pay taxes? No, I'm excluded because it's up to $250,000, right? And I only made $105,000. If I'm married, it's up to $500,000, so I'm still excluded from this. This is only for residential property, okay? This is only for residential property, and this can be claimed every 2 years. So I'm in one property, I live there, I sell the property, I go into another property. Okay? I live there, I go into another property. So every 2 years, if that was my residence, or if it was my principal residence, at least 2 out of the previous 5 years, I can claim this exclusion and not pay taxes at all on the $100,000 I just made. Okay? Did you guys understand that? How to legally avoid paying taxes. Knowing the laws. Moving every 2 years. You don't pay taxes on gains up to $250 if you're single. You don't pay taxes on gains up to $500 if you're married. You must have lived there for at least 2 years. It says right here. You must have owned the property for at least 2 out of the previous 5 years, right? And you must have used the property as a principal residence for a total of those 2 years. And of course, you waited at least 2 years before you claimed the exclusion again. Question coming through. Just keep moving. You guys ever watched Nemo? Think of Dory. Instead of just keep swimming, it's just keep moving. That's it. Every 2 years. There's always a movie or a storyline that I can use for this, or a song. Do you have to sell, or can you move from principal residence to the next every 2 years? You have to sell it within the 5-year period. You must have lived there for at least 2 years. Sell it within the 5-year period. So to answer Jackie's question, but who is moving every 2 years? Well, Jackie, let me ask you something. If you had to pay, so current capital gains, current capital gain tax on long term is 15%. If you had to pay 15% of this money, right? 100,000 is not bad. If it was more, it would be worse. But if you had to pay 15% of this money, isn't that worth moving? I mean, that's the money for you to move, and some new furniture too, right? So not a bad deal. Move every 2 years. But you can move every 5 years. You don't have to move every 2 years. You just have to have lived in that property, right? You have to sell it after living there for at least 2 years. Could you live there for 5 years and then move to another property and then live in the other property for 3 years before you sell the previous one? Sure. So yeah, you could actually extend even more. Okay. Okay, just so you know, Yemi, just so you know, private messages still show up. Okay? I have it here on the chat. All right, here's what I'm going to do, guys. Let's go. It's 7:50. We're going to go into a quick break before you get to the next phase of this chapter. We're going to a 10-minute break. We'll be back at 8 o'clock, okay? Is that cool? Thumbs up? All right, cool. Yvette, can I scroll back? Where? Here? More? What are you doing? You want me to go there? It's here? Okay. I don't know. She's going like this. I don't know if it's like keep scrolling or come here. Oh. All right, guys, go for your break. I will switch as soon as Yvette's done. So go for your break. If you're watching on YouTube, I'm going to close the session. I'll be right back with a brand new session, okay? Yvette, you good? All right, cool. I'll see you guys in a little bit.